Hello everyone. Now again, the continuation of the same unit 2, the second week, we got to two chapters. As I mentioned in the last chapter, chapter 2 and 3. But this one I'm going to record separate so that you can do one chapter at a time, but still you got to finish everything within this week. And some of the assignments on the blackboard, you can do that too. If you can, go ahead and do that. But there are some issues, some students have issues getting into that. We can discuss. If you have issues, let me know so I can address that. This chapter, we're going to go over the balance sheet and financial disclosures. Now, we did discuss a lot of things that we're going to see here in this chapter, in the previous chapter too, because in the previous chapter 2, we discussed financial statement, which include the balance sheet. So we went through the certain items that you're going to see it again. Okay, but that's okay as a reminder. But we're getting into a little bit more detail in the balance sheet items, just so that you're going to have all the information you need about a balance sheet. All right, let's keep going. Okay, what is a balance sheet? It's a report of a company's financial position at a point in time. I did tell you in financial statement we have income statement, the balance sheet, cash flow statement, and other comprehensive items, and also some people separately reports equity section. But in income statement provides you the data, the information about activity throughout the year, whole activity, year or whatever the period that you're reporting. But in a balance sheet, it gives you where you are, what do you have, what assets, what liabilities you got at a certain date. That's what it's called, at a point in time. As a December 31st, 2020, whatever it is. Okay? It provides an organized array of assets, the liabilities, and shareholders' equity, grouped according to common characteristics. Okay, let's go to the next one. Okay, here we have a typical balance sheet of an entity. This is the asset section. Okay, we do know that we have assets, liabilities, and equity. The section equity, shareholders' equity of an organization you see in a balance sheet. Now here we have assets. There's Under Armour Corporation. It's a consolidated balance sheet. You might see, what is a consolidated balance sheet? You all probably you heard of. Consolidated balance sheet means, suppose since you have, see, its name says the subsidiaries. When you say the subsidiaries, what does that mean? You got a parent company, which is the Under Armour itself, okay? Then we have subsidiaries that are in multinational corporations or even a large corporations. They got subsidiaries all over the place. Okay, here in the US, they operate different countries. As that unit, wherever you set up, is a subsidiary of the parent company, right? So that's what it's called, subsidiary. Now, when we put together income statement for everything included in just one set of books, one set of finance statement, that's what a consolidated means. Consolidate everything together, okay? Give you a perspective of entire corporation. They do their own financials, okay? They have company A, B, C, whatever it is. What they do, they then bring everything together. That's what a consolidated means, okay? I just want to throw that out. I'm pretty sure you already know that, but to give you a refresher. Now, what is this? What do we have in a balance sheet? Asset section, we got current assets, which include current items. You get into that. What are these? Cash. The main, usually we list those assets in order. Liquidity, by liquidity. Okay, what is the most liquid assets that you have in a corporation? It's a cash. Cash, you got liquid quickly, right? Cash, you can pay whatever it is, that's the cash. And cash equivalents. What are equivalents? Cash equivalents also, we're going to get into that. So very quickly you can convert it into cash without having any loss. Like bank drafts or whatever, the short-term notes. Accounts receivable, you get inventory, and prepaid expenses. All these are, when you say current, it is within a year. Okay, and then we have other items. These we call fixed assets. Now this one is a property and equipment, and then we have a goodwill, intangible assets, other type of intangible assets. These called intangible, goodwill, and other intangible assets, maybe trade names, trademarks, whatever it is, right? And then we have deferred income taxes. What is the deferred income taxes? Your income tax you're responsible for paying in the future. Okay. Now, actually, deferred income taxes, that's an asset, income tax asset. You already paid, you can utilize for book purposes. It's going to be used in the future. Okay. When we talk about tax part of that accounting, we'll see how that, what exactly that means. What is a deferred income taxes means? Because for tax purposes and book purposes, for book purposes we use GAAP. It's a different set of rules, right? But for tax purposes we use tax laws. Tax laws allows us to use or deduct certain items, but book doesn't. Book use the GAAP, and vice versa. So that's why we create either asset or the deferred tax liability. Okay, I'm not going to getting into too much detail about deferred tax asset or liability at this point. Okay, now we have other long-term assets. We gotta go and look what these items are a little deeper. Then the other section, other part is the liabilities. In a balance sheet, you got a liability. Also, you have current liability, accounts payable, accrued expenses, all these that you already know. Now we have something called current maturity of long-term debt. What does that mean? So that's something. Now, when you say the current maturity of long-term debt, now supposing you borrow $100 million, okay, you have to pay in 10 installments. What does that mean? Next year, you pay 10 million of that, right? That becomes, since within a year that you have to pay, that 10 million becomes the current portion of long term. Okay, that's what it is, 42,000. Okay, remember that. The other current liabilities, you may have some other small items. And then you have a long-term debt, net of current maturities. Then you have revolving credit facilities, long-term, and then other long-term liabilities. So that's your total liability. Then you have, as I said, it's a stockholders' equity. It consists of mainly three items here, 3 or 4 items. It says common stocks, 72 million. Or 72, and then you have additional paid-in capital. Everybody knows what is an additional paid-in capital. Now, even though the common stock, you might say $10 a share, that's the par value, or $5 a share, but it usually sells at much higher price. So it's going to sell at $100. The market price is not the same as par value. Par value is just a number. Okay, so when you sell at a higher than the par value, the difference, that's the $90, goes into additional paid-in capital, and $10 goes into common stock. Everybody understand that? Okay. And retained earnings, I explained what a retained earnings is. You keep the profit in the business. Okay. You have an income, you get expenses, then you have profit, right? Income minus expenses gives you a profit for that year. Okay. Then from that profit, either you can pay a dividend to shareholders. If you pay a dividend, you deduct that as well. And then what is left is retained earning for that year, right? So that gets accumulated over the years. So that's what it is. Accumulated other comprehensive loss. So the comprehensive items, we're going to look into that as well. Those are some extraordinary type, not extraordinary, but other items that not necessarily we used to compute our net income or net loss. Okay. All right. Now let's go to the next slide. We're going to call now looking at a balance sheet. What do we use it for? What's the objective? What's the usefulness of the balance sheet? Assets are grouping according to common characteristics. I said it's the liquidity. Grouping provide useful information about liquidity, ability of a company to convert its asset to cash, long-term solvency, whether the company will be able to pay its long-term debt, financial flexibility, okay, the ability of a company to hold the cash flow in order to take advantage of unexpected investment opportunities and need. What exactly this is talking about here? When you look at a balance sheet, based on the items that you see, a good investor or analyst going to see the corporation. You can have a nice liquid assets, get a lot of investments. So you know the entity is going to have a very good long-term solvency, and they have financial flexibility. That means you get enough cash, you can invest anytime you want. Okay, that's what it means. Okay. Remember, there are some limitations to the balance sheet also. The balance sheet is a company book value. Asset minus liabilities, as shown in the balance sheet, usually will not directly measure the company market value. We all know. The balance sheet, what do we put in the balance sheet? It's a historical cost. Remember? Yeah, that's what it says here. Two primary reasons that a balance sheet does not portray a company market value. Why is that? We know if you get a building or the land or whatever the machinery, we usually measure their historical cost. What did we pay for that the machine or the asset, right? So over the years, supposing you acquire a building or land, wherever it is, usually the land value goes up for $10 million. Now 10 years later or 20 years down the road, now it has gone up to 100 million. But what we don't do in a balance sheet, we do not report the market value of that asset, right? We always have the historical value. So that's what it means. Now, when you look at a balance sheet, you may have 100 million of total asset, but in reality, the market value of the entity, the asset, total asset, may be $1 billion. Okay, that's one of the limitations that we see. Many aspects of a company may represent valuable resources, but these items are not recorded as assets in the balance sheet. Now, there are a lot of things that we do not record in the balance sheet that has a value. A very good example, I think I mentioned that already. How about people? How about employees? The human resources. It's the most valuable asset in a corporation, right? It's doing well. The skilled workers. If people leave, company can't survive. They might hire people, but they don't have experience. So that's what it's very important that we know that. Okay, those things are limitations in a balance sheet. Looking at a classification of elements within the balance sheet, you can see, we know, now we did that, we did look at equation, which is going to repeat here. Okay, the assets, the current assets, long-term assets equal the liabilities, which include the current liabilities and long-term liabilities, plus the shareholders' equity. Again, as I said, we already discussed this stuff in a prior chapter. Just repeating ourselves. I'm just not going to spend too much time. Let's take a look at this quick example. Which of the following is a subclassification of assets in the balance sheet? Subclassification of assets. Cash and cash equivalents is an item, and the revenue is not part of balance sheet. Disposable assets, we don't usually put like that, but it's the current assets. Is the subclassification. Remember, current assets, then you have long-term assets. Okay, that's the answer for that. Now, current assets, you can see current assets are those assets expected to be converted to cash within the coming year or within the normal operating cycle of a business, if that is longer than 1 year. What do we have here? If you look at this quick schedule, as you see, operating cycle of a typical merchandising or manufacturing entity. You pay cash, use cash to acquire inventory or manufacture inventory, prepare inventory for sale to customers. That's the manufacturing part. They deliver inventory to customers. Then you collect cash. Then it's a cycle. You go back. The cycle. That's what it's a typical operating cycle of a corporation. Again, here's elements of current assets, what include typical components, cash and cash equivalents, the short-term investments, accounts receivable, inventory, and prepaid expenses. It says the component current assets are listed in decreasing order of liquidity. Remember, the most liquid items we list at the top. Okay, cash and cash equivalents, you have cash on hand and cash in banks. Also, sometimes you have a bank drafts, a cashier's checks, the money orders, all these cash equivalents items. Cash equivalents, the maturity date of 3 months or less from the date of purchase. Commercial paper, the money market funds, and treasury bills. Those can be converted into cash within 3 months or less without losing the value. Short-term investments, the investments in stocks and debt securities. We know what they are. You buy stocks or buy bonds. Debt securities are bond type of item. Okay, that the company has the ability and intent to sell within the next 12 months. That's the short term, or operating cycle, whichever is longer. Short-term investments. Short-term investments also can be divided into certain ones. Here you got held to maturity. Now, if you buy a bond, now again, this short term. For 6 months, you keep it. You buy it today, January 1, they're maturing 6/30, or it's just 1 year items, that's 12/31. You keep it, you held it to maturity before selling. Then you have a trading securities. Trading securities, you buy and sell, and the securities available for sale. Now these ones you sell only when you see an opportunity, the high prices, whatnot. You keep it. Whenever time comes, you sell it. That's the 3 different type of investments. Accounts receivable, we all know what it is. Account receivable generated by selling goods on account. Okay, we are not getting cash at the time of the sale, but we are collecting cash at a later time. So we have accounts receivable. Results from sale of goods or services on credit, we know that, often referred to as a trade receivable. Trade receivable. No, non-trade receivable results from a loans by the company called what? It's a note receivable. You lend money to somebody, that becomes a notes receivable, not accounts receivable. Okay? The different terms used for different things. Supported by a formal agreement or note that specifies payment terms that you're going to collect interest on that note. But accounts receivable, there's no interest, but the company or the buyer, the customer, going to pay at a later time, within a month, within 2 months, or whatever it is. Inventory. When it comes to inventory, we are still going over the current assets portion of the balance sheet. Inventory is a very, very important item, whether it is manufacturing or is the retailer. Regardless, the retailer has inventory, but it's only certain type of inventory. But if you are a manufacturer, you might see 3 different type of inventories. Finished goods. We got a raw material and working process and finished goods. You know what they are. Raw materials, if you're a manufacturer, you buy raw materials. This should be this way, okay? Raw material first and put into make a product. Suppose here is a 1231. Now the product, suppose you are putting together a table. You get all kind of you started putting your lumber together, right? It's not done by this date. You introduce the material that costs $10, right? But here it's halfway done. That's what we call working process. It's not done, it's in the process of working, but still has a value. So that's a part of your inventory when you have a manufacturing type of corporation. So then you got to finish it. That's why you got to finish goods. Finished goods, you have inventory as well. Okay, prepaid expenses, we discussed that in the prior chapter as well. Represent asset recorded when expenses are paid in advance, creating benefits beyond the current period. The current or non-current depends on when this benefit will be realized. Example, prepaid rent and prepaid insurance. We buy prepaid rent, say we pay rent $60,000. The similar examples I think we see before for 3 months, or rather 3 years. So you go to, we're going to put it a prepaid rent. That's an asset, a current asset. We're going to utilize the 60,000 or use this 60,000 for future years, right? Right away, it's not an expense until you use it, use the benefit. Similar thing is a prepaid insurance. We buy insurance for yearly or maybe a couple of years at a time. You're going to use it in the future. That's what prepaid expense is coming in. Okay. Take a look at this quick example. Just your knowledge, what you learned so far. The current asset include cash and all other assets expected to become cash or be consumed. Which one is correct? It says A says within 1 year, B within 1 operating cycle, C says within 1 year or 1 operating cycle, whichever is shorter. D within 1 year or 1 operating cycle, whichever is longer. What did we learn? We learned current assets that are expected to become cash or consumed. Are there any assets that are expected to become cash or consumed within 1 year or 1 operating cycle, whichever is longest, considered current assets. Okay. All right, let's take a look next one. This is a long-term asset. Asset expected to provide economic benefit beyond the next year or operating cycle. The typical assets, we have investments, we have property, plant and equipment, intangible assets, and other long-term assets. Now we know what intangible assets are, right? We know the property, plant, and equipment. We know all that. That's the tangible assets. Investments, we put money, we buy stocks, and we buy the bonds and whatnot. Then we have intangible assets, which is like goodwill or trademarks or those kind of things. Let's see, investments, we did mention that assets that are not used directly in the corporate operations of business. This example, investments in equity or debt securities of other corporations you buy. You buy shares or you buy bonds. If you have excess cash, that's what you do. You buy, you invest them, all these other type of security that make money. Land held for speculation. That means you get a land, but you're going to sell it at a later time. The long-term receivables, cash set aside for special purposes. Okay, the property, plant, and equipment, you know what they are. It's a tangible, long-term assets used in operation, used in the operations of the business. Reported as a single amount in a balance sheet at original cost less accumulated depreciation. Now we know how to report long-term assets, the property, plant, and equipment. You get a historical cost, say $100 million, and then 100 million. Then you have accumulated depreciation, say 20 million. You get a net is 80. That's how you report in the balance sheet. Examples: the land, buildings, equipment, the machinery, furniture, and vehicles, as well as the natural resources such as the mineral mines, timber tracts, and oil wells. Those are also considered assets, the long-term assets that use in the operations of the business. Intangible assets, we did mention that before. They generally represent exclusive rights, valuable resources in generating future revenues, reporting the balance sheet, net of accumulated amortization. Now you remember that's when we have property, plant, and equipment, how we report? Net of depreciation, accumulated depreciation. Now when it comes to intangible assets, what do we call? We call amortization. Same thing, but two different names. Okay. When you have goodwill or trademarks or anything else, we amortize it over the life of that asset. Usually, actually, goodwill is not amortizable asset for book purposes. I want to make sure that you understand that goodwill we do not amortize. That's the item, that's the intangible item we do not amortize. But that's book purposes. But for tax purposes, remember, the goodwill is amortizable. We amortize in goodwill for the 15-year period. Okay, that's for tax purposes. You can deduct. That's what amortize means. Amortization. Okay, amortization expense you can deduct for goodwill, but not for book purposes. GAAP doesn't require GAAP. Doesn't want you to amortize the goodwill, but you amortize other items. Much of the value is not reported in the balance sheet. Example: patents, copyright, trademarks, and franchises. Sometimes if you buy, then you have reported the balance sheet. But if you create patents on your own or copyrights your product or the trademarks, we do not report in the balance sheet. Okay, keep that in mind. Okay, we have other long-term assets. They represent a catch-all classification of long-term assets that were not reported separately in one of the other long-term classifications. What is left? You're going to put other. Okay, we reported, the fixed assets, the long-term other type of assets that's not included. You could put in here. But include long-term prepaid expenses, deferred charges, like taxes. You can put there as well. The might also include long-term investments, not material in amount. The key to understand which category an asset is reported in management intent. okay, whether you're going to use to generate profits or generate income for, then what's the assets going to be? How long that asset's going to last? That's what they talk about here, the management intent. How long that asset going to last? How long that asset going to use? So based on that, or what purpose is going to use, then that's how you categorize these assets. Okay, let's go to the next one. The concept check to long-term assets. Which of the following is most likely to be reported as a long-term assets? Accounts receivable, we know that it's not a long-term asset, right? It's a current asset. Building, how about prepaid rent? How about inventory? None of these. Not this. Okay, let me put it here to make sure I got it. Okay, not this. Not this and not this, right? But in this, the building is the long-term assets. It's a long-term asset. It's the building. Other assets are the current assets. This is a typical, the represent obligations to others. The liabilities section of the balance sheet, you can see. Now, usually, you can see when you put a balance sheet together in a financial statement, you usually comparative purposes you to 2 years together. You can see as May 31st, 2014 and May 31st, 2015. You comparative purposes you put those 2 years together. And sometimes they put 3-4 years in the balance sheet. Most part is 2 years. Okay, you have all these items, the current liability, the current portion of long-term debt. I think we went through that already. Notes payable, accounts payable, accrued liabilities, and all that stuff. Okay, I'm not going to spend too much time. You can go that. Let's look at that. Current liability parts here. Again, the same thing they're repeating. The obligation that are expected to be satisfied through the use of current assets or creation of other current liabilities. All right, let me explain what that is. Okay, you got, they're saying obligation, current liability, and an obligation that are expected to be satisfied through the current assets. Now, supposing you have accounts payable. Here's accounts payable, right? So you can pay off with cash you have. That's your current assets, correct? Current assets. You can pay with the current assets. Oh, if you don't have enough money, what are you going to do? You borrow money. Then what you have to do, you create other current assets to pay off accounts payable, that when it's become due, right? That's what it means. Expected to be satisfied within 1 year or operating cycle, whichever is longer. We already learned that before. Okay, again, all these items under the currently maturing portion of long-term debt. I explained that before. All right. Now here's an example of current maturities long-term debt. The long-term notes, loans, mortgage, and bonds payable, it become payable within 1 year, within the next year, or are payable in installment. So if that's the case, usually when you have a loan, it's not, if it's a long-term loan, sometimes you got to pay in installment, or annual basis or quarterly basis, whatnot, right? So when you have that kind of situation, suppose this example, you got $1 million notes payable, recurring 100,000 in principal payment to be made each of next 10 years. You got $1 million, you have to pay in 10 years. So installment is going to be 100,000 each year. So every year you got to move. This is the current portion which you're going to pay next year, right? So in the balance sheet, you have to make that classification. You move from long term to current because every year that's 100,000 need to be paid off. So that's why. So long-term liability, therefore, is only 900 of the million. Okay, that's simple. You can understand that. Long-term liabilities, we know what they are. Obligation that will not satisfy in the next year. or operating cycle, whichever is longer, do not require to use current assets or create current liabilities for payment. Okay, impact on future cash flows and long-term solvency is assessed by the reporting, payment terms, interest rate. These are long-term loans, so whatever you borrow money, bonds, whatnot. Example, long-term notes, the bonds, the pension obligations, the lease obligations, and all kind of stuff. Okay, those are long-term, more than a year to pay. All right. Now, you're getting the shareholders' equity section of the balance sheet. Residual amount derived by subtracting liabilities from assets. Now, you got assets, and you have to pay for third parties, right? The liabilities, all the liability, current and long-term liabilities. What is left is what's the shareholders' equity. Usually, asset minus liabilities should equal to shareholders' equity. What is left for the shareholders, right? Derived primarily from paid-in capital. That's we said what's the paid-in capital consists of. You mean a common stock. If you're separating it, common stock and paid-in capital in excess of par. We know what they are, right? We explained that before. And what is and retained earnings? Retained earnings, that's the profit that retained in the business. Sometimes referred to as net assets or book value. Net assets means asset minus liabilities give you a net assets. Net asset is what the owners can take home. Just in case, suppose you're going to close down the business. You decide December 31st comes, we pay up all the liabilities, the current, the long-term liabilities, and what is left for us? That's what's the net assets. Okay, include other equity components such as accumulated other comprehensive income, also as part of the shareholders' equity. That's not going to be reported in income statement purposes. I mean, computing net income or net loss, but it is reported in the shareholders' equity section. Disclosure is important part of putting together financials. Why disclosure? Again, I think we mentioned that before. Now, at the end of each fiscal year, the companies with public securities are required to provide shareholders with annual report. When you say public, you're selling stocks to the public, right? You and I own a couple of shares here and there. So that's the public corporations. They're required to provide us, the shareholders, with an annual report, which include financial statements, income statement, showing what exactly happened during the year, right? Operations, and then balance sheet, or even cash flow statement supposed to be included, and all the financial statement that we know. And then additional disclosure. Now, what do you need an additional disclosure? You have financial statement, but sometimes the financial statement, just a number, probably doesn't mean anything to reader like you and I know nothing about financial, right? So you got to dig deeper to understand what that number is. They might put a number here or anything. So they have to explain what it is in the certain language that everyone can understand. They're going to change their way of thinking, the decision making. Suppose and say I'm an investor. I'm looking at in a final report to see whether I'm going to make an investment in the corporation. So if I look at their financial statement, there's an item that I don't understand. So without the disclosure, so I might not make a decision as to whether I invest or not without knowing what that item is. This is a material item. So if that's the case, they have to explain what it is. Okay, it's an extraordinary item, whatnot. It's a big loss. Okay, for that year, maybe a flood or maybe a fire, because that kind of thing. So, which may include items related to business conditions, okay, risk factors, legal proceedings, stock performance, and internal control procedures. Everything is supposed to be included. That's the disclosure. Okay. Disclosure notes explain data presented in the financial statement themselves or provide information not directly related to any specific item in the statement. Okay, sometimes you got to give some information in the notes. Pension plans, how much pension plans, how much money you got, what's the liability, pension liability, the leases, also the long-term debt, investment, the material items. They must include summary of significant accounting policies. Okay, what policies you use under GAAP? Certain you can use certain ones. Sometimes there's an alternative of the policies that you can use. The description of the subsequent event and related party transactions. You know what they are. Description of subsequent event. Suppose you're closing the books at 12/31, right? So that's the information is the financials only shows up to 12/31 that during that year. But you're going to publish these reports, say March 31. So during this period, something happened, a big event, maybe a fire, destroyed huge plant, whatnot. So that's the big item. So that's the subsequent event. So you got to include that also. This person who reads this sees what exactly happened after the fact, that the financial ending date is 12/31, but before you publish the income statement or the annual report, that information is material enough, you got to include that as a subsequent event. Related party transactions. If you have any related party transactions, like you have subsidiaries, you're buying and selling between parties, related parties, or even if you are the owner of a corporation, selling assets to shareholders, those kind of things. That's a related party. Okay, those type of information should be disclosed to the public. Specific disclosure notes, summary of significant accounting policies. As I said, we're getting into the detail, this stuff. Okay, conveys valuable information about company choices from among various alternative accounting methods. Like inventory method, you got a first in first out basis, FIFO, LIFO, which one you use, or average method, depreciation method, which one you use, those kind of thing. And if it's a construction company, what do you use to recognize the revenue, percentage completion method, or whatever it is, right? So those are the things that we mentioned here, the significant accounting policies. Reason is, if you're comparing one entity to another, you have to know that entity might use a different policy. So for comparative purposes, at least you have to know what this entity uses versus the other. Okay, that's the main important thing to remember. Again, the subsequent event occurs after company fiscal year end, but before financial statement are issued, whatever happens. Examples: issuance of debt or equity securities. It's a material item, right? The business combination, sale of business, sale of assets, even that sheds light on the outcome of a contingency, like lawsuit or whatnot. Okay, somebody filed a lawsuit against the corporation. It's a huge, unpayable outcome comes, billions of dollars to pay off, like a medical malpractice or something like that. If you are manufacturer of medical devices, those kind of things. It's important people to know before making an investment decisions, right? Okay, noteworthy events and transactions. Again, as I said, the related party transactions are important. Transaction between company and owners, management, families of owners, and then errors and fraud, misstatement that are unintentional, that is errors, and then intentional changes, the fraud. Okay, it's considered fraud. If you find something, you got to make sure that you put it in. The auditors find some stuff, before they release the financials, income annual statement. So you have to put that stuff in there. Okay, illegal acts, the bribes, the kickbacks, the illegal contributions, and to political candidates. Those kind of things is important people to know. Okay. Okay, we take a look at this one. Which of the following would be commonly reported in the summary of significant accounting policies? We are talking about significant accounting policies, right? Commonly reported. Errors and fraud, it's not a policy. Okay, the method used in the record of depreciation. Okay, that sounds good. Subsequent events is not a policy. The related party transactions, those are not policies. This is the one. This is the policy. Different method can be used, right? Okay. Now let's go to the next one. Compensation to directors and top executives also is important for people to know how much they get paid. Securities and Exchange Commission requirements provide for disclosure on compensation to directors and executives. They cannot pay lavishly. The millions of some people get paid, but that should be disclosed to the public. Okay, the proxy statement must be reported each year to all shareholders, usually along with the annual report. Proxy statement invites shareholders to annual meeting to elect board of directors, the board members, and to vote on issues or to vote by proxy. Include compensation and stock options information for directors and top executives. That's important. Now you get, if you own the shares of a larger corporation, some of you might, you get what do you call these proxy statements. You know, when we have voting coming up, annual meetings, you're invited to an annual meeting. So you get that kind of information with everything, including the compensation, stock option information for higher office executives, top executives and directors. Okay, auditor's report. Now you're getting into, now we look at the balance sheet, income statements, we look at the financials. Now you learn what they are. But now if you and I, as a general public who know nothing about financial statements, how are you going to rely on the financials? If you're an investor, you have $1 million to invest, but you know nothing about finance or accounting, even to read an annual report. But assume you can read. How do you know whether those are correct information is included in the financials? So people can put incorrect information, as we see, errors can be there, or intentionally, like that happens. I think we mentioned that before, many years ago. The audit firms also just ignored the things that went through those corporations, the manipulations of the numbers, to show that they're making profits. Actually, they did not. They're generating losses. But by manipulating numbers, they can put together the financial statements that people can see. They can say, wow, this is a good corporation, entity to put my money in. So what happens if you see an income statement, annual report, showing 30% or 20% growth, but actually they're making losses. The growth, you can change the numbers and just come up with any number you want to put in the financial statement to make other people believe that's what's actually happening, right? That's what the auditors comes in, especially when it comes to public corporations. GAAP requires that you have to have an auditor examine the financial statement and internal controls and issue a report. So if you do not know anything about the entity, but if you can read the annual auditor's report, that tells you whether it's reasonable, it's accurate or not. Okay, that's what auditor's report is all about. Auditors examine financial statement and the internal control procedure. They attest to the fairness. Okay, again, they're going to say how fair this information is of the financial statement and results of opinion stated in auditor's report. Again, they're not going to say this is 100% accurate. They are not going to say this is correct 100%. They're not guaranteed anything. But they're going to say it's the fairness. They're going to attest to the fairness of the financial statement. Reasonably, they follow GAAP. That's what it says. We're going to look into is individual type of reports that they're going to issue. Okay, 4 basic type. So as unqualified, something called unqualified with explanatory paragraph. We got a qualified report. Then you have not giving anything at all, the adverse or disclaimer. You got to give a bad report, adverse report, and then you got to disclaim. You're not going to give any report. Okay, which one you think is the best one to have? When you look at the term they use, unqualified, it looks like that's the bad one, right? But that's the best one to have. Corporate executives, people running the business want to have this. They don't want anything else. Okay? So let's see what it is exactly. Unqualified report. Unqualified reports, an audit issue, an unqualified or clean. Now you can see. If you say clean, then you understand well, but it's unqualified, you might confuse as to what the term they're using, right? Opinion, when an auditor has undertaken professional care. Okay, that's the important thing. As an auditor, you have to use a professional care to ensure that the financial statements are presented in conformity with generally accepted accounting principles or GAAP. That's all you're going to look. Okay, professional care would include sufficient planning of the audit. That's what it means, professional care. When you take a job, you got to do it right. You got to do certain things. You got to follow certain steps. This is the steps that they're supposed to take when you doing an audit. Sufficient planning of the audit is important. Understanding the company internal control procedure. Gathering evidence to attest the accuracy of the amount reported in the financial statement. Very important. If you miss any of these, you're not going to issue a good report. You're not going to issue it means you cannot really tell the public, yes, we did audit, we examined the financials, it's good or it's bad. You cannot really say that without going through this thing. Okay, that's what I say. These are important. Unqualified. If you're going to use unqualified opinion, this is explanatory paragraph. Yeah, it's going to be good, but with subject to certain areas. It's not, they're not going to issue, they're going to say, okay, subject to this area, with except this area, something like that. Okay. Pretty sure when you take, I'm not sure how many people you took auditing course. When you take an auditing class, you're going to learn everything. The very important, the audit report is very important. That's the ultimate goal of an audit. So that's the results. That's the bottom line, right? So when you doing an examination, you issue a report. So you have to know what to include, what not to include, how to write a report, what exactly it means, certain terminology, right? Circumstances where the auditor believes the financial statements are in conformity with GAAP, but other important information need to be emphasized in the financial statement users. Situation, lack of consistency, going concern issues, emphasis of a matter. Sometimes, these type of things, they're not consistent using certain things. Okay, that you got to put something there. Yeah, they're following the GAAP. It's good, but we have these issues to mention. That's an unqualified opinion with the explanatory paragraph. Okay. Then you have other type of report. Some audit results in need to issue other than an unqualified opinion due to exceptions such as non-conforming with generally accepted accounting principles. People don't use GAAP. They don't follow GAAP. If that's the case, the auditor is not going to issue a qualified opinion. Okay? And inadequate disclosure. There's some issues. You have to have, GAAP says, you got to disclose certain things. If you do not have it, then you cannot issue unqualified opinion. A limitation or restriction of the scope of the audit examination. Sometimes they might say, okay, if you are an auditor, you ask for certain information, the company's executive says, no, don't worry about it, okay? And sometimes you want to go inspect a warehouse, inventory. They said, no, you can't go there, just that's good number. You can. Those kind of limitations, they restrict the restrictions or limitations of the scope, right? You cannot really do your job properly if they have these type of limitations and restrictions on you. So in that case, you cannot really issue an unqualified opinion. Okay? In this situation, the auditor will issue an qualified opinion, adverse opinion, or disclaimer. Adverse is the bad one. Okay? The disclaimer you don't issue at all. Okay, now we are looking at this quick example here. Disclosure. Which disclosure provides an independent and professional opinion about fairness of the representations in the financial statement and about the effectiveness of internal controls. What are you going to do? It's the auditor's report, right? Okay. Let me start. Okay, now we are at a point where we can look at the financial statement. We learn how to put together financials, right? The income statement, the balance sheet, and the the financials, and we learn how an auditor look at it. Auditor review, examine, and issue an auditor's report. Now, supposing you have everything done and you got your financial statement for you to review. Especially if you're an investor, what are you looking at? What's the CS? Financial statement analysis. That's what you're looking at now. Various tools and techniques are needed to formulate prediction. What's going to happen next year, the following year, 10 years from now? It's very hard to predict for a long term. But still, people put together these type of financial analysis and predict certain things, at least for short term. Comparative financial statement, looking at the finance statement, the corporations for prior years, maybe 2 or 3 years prior, then you can see in column of forms, if you put all this, okay, year 1, 2, 3, okay, these areas, you can see, okay, year 1, 2, now is the third year. It's the growth, okay, the sales going up. Okay, all kind of things. The profits going up. That's what I was looking at. Okay, and then you assume this trend going to continue. You're going to see, okay, next year you're going to have another 10% or the growth. Okay, that's what the predictions is talking about. Horizontal analysis. Each item is presented as a percentage of base year amount. So horizontally, you're going to look this year, base year, say they started 2001 and 2002 and 2003. Base year 2001 is 100%. So what happens year 2? It's now increased. Now it's 105% of base year. Increase, the growth, the sales. If you're looking at the sales, that's what the horizontal analysis means. The vertical analysis, going down, you start the sales. The finance statement items are converted to ratios. You get the sales numbers comparing what is our profitability. Okay, sales to the cost of sale to gross profit to operational profit, percentage wise each year. So this year is 10% profits. Next year 15%. It's a growth. Next year 18%, so on and so forth, right? So that's what we're looking at. Comparing to sales. Sales, that's what is this tells you. Sales may be dropped, but efficiency has increased, thereby your profitability has increased. If a sales drop, say this year sales 100, now it's 90 million. For whatever reason, sales has dropped. However, the profitability has increased, which tells you the cost of sales and the other operating expenses has reduced or decreased for various reasons. Efficiency. They put together something that's going to reduce cost, right? Maybe there was something you did manually, now is computerized. Okay, doing by machines now. The cost is less, and so on and so forth. That's what we're looking at. You know, where the vertical analysis, each item represents percentage of total, and then ratio analysis, looking at a financial statement items converted to ratios, looking at ratios. Again, it's 10%, 20%. You can look at it and compare to the industry. Okay, those are the things that people do to come up with a prediction where this company is going. Okay. Okay, the concept checked. Again, risk. Which of the following describes the risk that the company cannot pay its obligation when they come due? Is operational risk, or cash management risk, or horizontal risk, or the default risk? It's the default risk. You cannot pay. If you cannot pay, that's the risk of defaulting. Okay, so let's go to the next one. Now, looking at the ratios, we mentioned that we're going to look at several different ratios. Okay, first being the liquidity ratio, referred to readiness of the asset to be converted to cash. How liquid our assets are, how quickly we can convert our assets to cash and pay obligations. Common measures, current ratio. Current ratio, you compute current ratio by your total current assets divided by current liabilities. Give you a ratio. Okay, it's 1-to-1 or above that. See, it's going to be good, higher than that. If you have $100 of assets and $100 of liabilities, you just pay off your liabilities with the assets you have. But if you have a higher, lower is riskier. That's what we're looking at. The higher is better. 1-to-1 or 5 is usually is better. Okay, when you pay off your obligations, the current obligations, you still have left the half of assets. Okay, that's what we look at. We put the numbers and see how that comes out. Then use something called acid test ratio or quick ratio. What is that? This tells you now this is a current assets, right? Current assets, sometimes when you sell those assets, you might, if you want to sell it right away, suppose you have inventory. Inventory, you cannot really sell right away without having to go through a lot of hassles and losses, right? They're going to cut down the prices to sell it right away. So in this case, acid test ratio remove that type of items from assets, quick assets, which exclude the inventory from your current assets, and then divided by current liabilities. Okay, the ratio provides information about company's ability to pay its short-term obligations. Okay, that's what the liquidity ratio is all about. Current ratio, just a quick example here. Popular measure of a company's ability to satisfy the short-term obligation is relations between the current assets and current liability. Example, Nike reported current assets in millions, say 15,976, and then current liability 6,000. So it looks good just by looking at, right? The working capital, now this one is a current ratio 2.52, which is much better. You got enough assets to pay off your liabilities, right? It's a lot. It's a good. This entity has a very good liquidity ratio. What is a working capital? Working capital, you get a current assets minus the current liability give you working capital. You have money. So just invest in a business. Simply, you can grow the business. If you don't have a working capital, you're getting into trouble. You have to borrow and pay interest, and those kind of situations going to happen. Okay, this is the type of very important information for you to look at. If you're comparing two entities, if you have again the money to invest, you're comparing this entity to another entity. What that other entity has only one ratio of 1. So where are you going to go? Rather you invest here, then that other entity has the higher risk of defaulting. Okay, when the the liabilities become due. Okay, keep that in mind. That's the current ratio. And acid test ratio, the quick ratio, what we do here, we gotta provide more stringent indication. Company's ability to pay this current obligation that exclude inventory and prepaid item, restricted cash, and all these other things that are not readily available to convert into cash quickly. Okay? Those items, inventory, prepaid items, how can you take the money back, right? So is it the current assets, but it's not going to be converted into cash quicker. So you remove them. The numerator include cash, the short-term investments, and accounts receivable, those items. So, example, Nike's quick assets, 9,282. That includes, you got a cash, you got a short-term investments, and you have accounts receivable. The asset test ratio, therefore, your current liability going to be the same, but only the current assets changes. But still, they're in a very good position, very good health as far as the liquidity is concerned, 1.47. Even if you pay with, you have the liabilities with the cash and short-term investment, still you have other assets, current assets back. Okay. Okay, let's see, are this liquidity ratio adequate? Okay, now comparing. Now look at those items. Now you're going to compare them. Common standards for such comparisons are industry average. For similar ratios of the same company in prior years. You're going to compare, okay, what we had last year compared to this year, or what we have compared to other competitors, the industry average. Okay, that's what people are going to look at. Industry average, a current ratio 1.41, acid test ratio 1.12. So as I said, Nike is very good. The position here, the ratio is higher than industry average. The Nike is the liquidity ratio to be in good shape too. See, so that's what we're comparing this to this. This is the industry. Industry much lower than the Nike, and acid test ratio is the same thing. Okay, comparing to those two, or even to some other the competitors. Okay, you got to look at the what we learn now here. You check the learn, check what we learn by looking at this question: which of the following transactions would increase company's liquidity ratio? Increase company's liquidity ratio. We know what a liquidity ratio is. Current assets divided by current liability. What happens here? Receive cash from customers on accounts receivable. What's happening there when you receive cash from accounts receivable? Cash also current assets. Accounts receivable also current asset, right? So when you receive cash, cash increases. Account receivable decreases. There's no change, right? The current assets remain the same. So therefore, it doesn't increase liquidity ratio. Okay? Stay with me. Now, what's the next one? The purchase office supplies with cash. What happened over there? When you purchase office supplies, again, office supplies is the current assets. Cash is the current assets. This case, office supplies increases, cash decreases, right? So no change again. Current asset didn't change. Pay dividend to shareholders. Now what's going to happen when you pay dividend to shareholders? Let me erase this. When you pay dividend to shareholders, cash reduces, yeah. So that's current assets decreases. The dividends we don't put it here, unless of course the current liability, say it's the current liability payable, right? So if you put it already, the dividends, so current liability also going to be reduced. So it might not increase your liquidity ratios. Okay, we take that out too. Now what do you have here? Borrow cash by signing a 3-year note. What happened over there? When you borrow cash, what happens? You increase the cash amount, right? That means you increase current assets. But what is this? 3-year note? It's not a current liability, right? Since it's not a current liability remains the same, but only cash increases. In that case, what's going to happen? And that's the only time that increases the liquidity ratio. Everybody understand that? If you don't understand, go back and just review this again. Okay, solvency ratios, debt to equity ratio. They provide some indication of the riskiness of a company with regard to its ability to pay its long-term debt. Now, sometimes your capital structure consists of equity and then the debt. That's you borrow money. Equity is your capital. You put in the business, right? So if the solvency ratio is not in a good mix, the company going into trouble. I'll show you how and what exactly we mean. Common solvency ratios. You got a debt to equity ratio. Total liabilities divided by shareholders' equity. That's the debt to equity ratio. Total liabilities, say you got 100 million. If you had a shareholders' equity, say 200, you got a 2-to-1 debt to equity ratio, right? Actually 1-to-10 debt to equity ratio, the way you look at it. Times interest, we can look at that also. Put numbers, okay? Let's put the numbers and see how that's going to work. Okay, debt to equity ratio compares resources provided by creditors with the resources provided by owners. Indicate the extent of reliance on creditors rather than owners. What does that mean? Instead of you putting money into your business as a capital, you borrow money. That's what it means. You rely on the creditors. Which, if you have too much debt, what's going to happen? You got to keep paying interest. So sometimes if you don't have enough capital, people who lending you money not going to lend you money at a lower rate either. So you have to pay higher rate of interest for the borrowed money. You keep paying interest, your profit's going to be diminished, right? So that's liquidity. Not liquidity, that's a risk of having too much debt. You're going to lose your business, right? Going to bankrupt. If you don't make money, you keep paying interest, too much interest, it's going to happen. Sometimes you have to have a good mix. I'm not saying borrowing money is a bad thing for business. It's good in certain cases. You borrow other people's money, make more money. You pay 5% interest and you make 10% return by borrowing money. Okay, that's a good thing for shareholders. But it's not always the case. You have to have a good mix. Okay, that's what you're talking about here. Debt to equity ratio. Provide a measure of creditors' protection in the event of insolvency. Other things being equal, the higher the ratio, okay, the higher the risk. If you have a higher ratio, risk is higher. That means you have a debt, too much debt compared to equity, your risk is higher. Okay. Let's look at this example. With the numbers, it's much easier to understand, right? So look at this example. Nike's liabilities are $8,893, okay, and stockholders' equity $12,707, right? The debt to equity ratio can be computed. Okay, you have a debt of $8,893 divided by your equity. They are in a better shape, 0.7. Now industry average is right here, 0.95, right? Nike is better over here as well. So you can see that Nike has a lower default risk. Okay, see the times interest earned ratio. Let's see what that means. Give me one sec here. Okay. Used in conjunction with the debt to equity ratio, calculated as a times interest earned ratio and net income plus the interest expense plus income taxes divided by interest expense. What does that tell you? If you have too much debt, you have too much interest, right? You have too much interest expense. So that's how much money you have to make. What is your total income? If you have income, suppose your income is $100, your adjusted income. Suppose your net income plus interest expense and income taxes 100. Your interest expense is 100. What do you have left? You got nothing, right? So that's kind of, let's put the number. This might not a good example, but let's take a look some numbers and you see. To remain solvent or take on more debt, a company needs to have funds available to pay interest charges, right? If you're going to borrow more money than what you have now, the companies, the borrowers, the banks, I mean the lenders, the banks going to look at your finances, look at this information. Interest earned ratio, how much, what is the ratio? If you have this kind of situation, your income is already being used to pay your interest, so no profits after deducting interest expense, they're not going to lend you money. And they're going to say, okay, I don't get interest. But what about my principals, right? They're not willing to lend you money if you are in this kind of situation. Okay, if income is many times greater than interest expense, creditor interests are more protected than if income just barely covers this expense. You understand that? What if you got 1,000 over here, but interest expense is only 100? You got 10 times, your income is 10 times than the interest expense, then lender is going to know, okay, that's better. We have a protection. There's no default risk over here. So you can lend you the money, okay? That's what we're looking at, this type of ratios. Okay, just a quick example, interest earned ratio, look at the Nikes. Nike going to look, net income, add interest expense, and add interest, the income taxes. Your total income before interest and taxes, you have 4,239. The time interest ratio going to compute your adjusted income divided by interest expense. You get 124 times of income than what you have the interest expense. You have 124 times interest expense to cover the income that you have. It's much better shape. They can borrow much money they want, right? The people who lending the money look at this, oh, they got enough money, they can cover my interest, I have no problem, there's no default risk. Okay, that's what we're looking at. Okay, that's a good example. Okay, let's go to the next one. Relationship between risk and profitability is always what? If you're high risk, you have to have high profitability, right? Let's take a look. While the default risk associated with borrowing, the company can use those borrowed funds to provide greater return to the shareholders. This is referred to as a favorable financial leverage. Okay, if and is a very common, but it is risky. You're borrowing money and invest and generate higher profits to shareholders. You borrow money at a 5%. Your return by using that funds, you're making 10% return. So is it a good thing or bad thing? It's a very good thing, right? So, but the problem is a little riskier. It's risky depending on your situation. Okay. When a company needs money, the alternatives are the debt or equity. Sometimes more debt can meet high return on shareholders' equity. You can see when you look at the example, you will see what exactly that means and how does it work. Okay, let's go to the next one. Okay, here's the example. You can see this example. Now look at newly formed corporation is attempting to determine the appropriate mix of debt and equity. Again, as I said, it has to have a good mix. The initial capitalization goal is 50 million. The capitalization mix alternatives are being narrowed to two. You got a one, you borrow 10 million and you put 40 million, your own money. Okay, that's one option. Two, you borrow 30 million and you put only 20 million in equity. So income before interest and taxes will be 8 million. The interest rate is 8% for those both cases. Income tax rate is 40%. Calculate the net income and return on shareholders' equity for both alternatives. Let's take a look at this one. So very good example. Let's take a look now how that's going to decide which one to use depending on the situation again. Okay, income before interest and taxes, 8 million in both cases. Keep it simple, right? 8 million and 8 million. Interest expense, depending on how much money you borrow, right? Interest expense for the option 1, you borrow only 10 million. So 8% of 10 million is 800, right? Option 2, you borrow 30 million. 8% of 30 million, 2.4 million, right? What is left now? You got income minus the interest expense. You got income before income tax, 7.2 million. And alternative 2, you got a much less, 5.6 million now, right? So income tax is 40%. You pay 40% of this, 40% of this. You have net income of 4.3 million using alternative 1, but alternative 2, you got only 3.6 million. So what's the problem here? Now, return on shareholders' equity, alternative 1, you got this divided by 40 million. That's your equity, right? 40 million. What do you have? If you have 40 million on equity, you're making 10.8. You can see this with my picture here, but let me put that number somewhere. What do we have here? You got a 3,360,000. That you simply what you do, 3,360,000 divided by what? 20 million. Remember, 20 million. 20 million equity. When you divide 3. Let's get to my calculator. You got a 3,360,000, right? Divided by 20 million. Net option, second option, they get 20 million in equity, right? That's you're dividing your net income by your equity amount, gets you how much? 1.68, is that right? Okay, let's take a look. Okay, actually, when you divide 3,360,000 by 20 million, you get 16.8, right? 16.8. So which one is better now? If you look at that, it's better to borrow more money, right? Borrow 30 million rather than 10 million, like previous, the option 1, alternative 1. That's the thing, depending on the situation. Let's go to just to change the facts a little bit, so you can see each. You got to look at the individual case, the case by case basis. Let's go to the next one. Now what do we have here? Things has changed. Now income has changed. Nothing else, right? If the income has changed to 3 million, not 8 million, now you got only, after adjustments, you got 3 million both cases, but interest expense is going to be the same, correct? Interest expense for the option 1 is 10 million, option 2 is 30 million, you got interest expense the same. So alternative 1, you are making 2.2 million income before tax, and you're paying 880,000 for tax. So left with 1.3 million net income. What do you have for alternative 2? you 600,000 income before tax, and you're paying tax of 40%, you got left with 360,000. All into one, you're making 3.3%. Okay. What about alternative 2 now? If you go to 3,600,000 or 360, divide by what? Divide by 20 million, right? 360 divided by 20 million. What do you get? 1.8. It's very low percentage, right? Now, in this case, you get 360 divided by 20 million. Gives me 1.8% of shareholders' equity, return on shareholders' equity. Now, if you look at two situations, higher income gives you a bigger return when you borrow more money. Think about it. Okay, now in this case, which one is better? Better options at less, borrow less, right? Borrowing less money gives you a higher rate of return. Okay, keep that in mind. Again, situation, case by case basis, you got to look. Okay, now this example, let's take a look here. Debt to equity ratio example. This entity has $1 million worth of assets, total asset of $1 million and total liability of 600. The industry average debt to equity ratio 1.2. Okay, the ratio indicate, calculate the debt to equity ratio and indicate whether the company default risk is higher or lower. If we were given this is industry, okay, so let's take a look here. Industry average is 120. So first we got to figure out, okay, what is their equity debt to equity ratio? How you figure out? You have liabilities divided by, we know the liability is given, right? What is the equity then? Divided by equity. Is it? So if that's the case, how are you going to find out equity? $1 million, your total asset. We know the liabilities plus equity gives you a total asset. So we know the equity then. This minus this gives you as equity, right? 400. That's your equity. So what is the ratio? 1.5. 1.5 is greater than the industry average. What did that tell you? Your liability, you have too much liability. So it is a higher risk. 1.5 is a higher risk. Okay, let's go to the next one. What do you say here? Information about major customers is important also to put together, put in the financial annual report. If you want to put, help financial analysts in providing information concerning the extent to which a company prosperity depend on one or more major customers. Now, if you have a very few customers with high sales to those customers, the percentage wise, if 10% or more of revenue of an enterprise is derived from transaction with a single customer, the enterprise must disclose that fact along with the total number of revenue, total amount of revenue from each such customer, identify the operating segment or segments reporting the revenue. That's important because what happens if that customer goes away? Your revenue is going to decrease drastically, right? So that's the important information. That's the major item. Suppose you have a customer, big customer, like United States government or the state governments, whatnot. Okay, big customer. You're paying, you're getting your revenue is coming from just one customer, maybe over half of your revenue. So if that customer decided to go somewhere else, you're going to go under, right? So that's the important information for analysts to know. Okay, keep that in mind. That information is very valuable, very important. All right, I think we're done with chapter 3 also. Let me put together some problems. I'm going to put some problems on Blackboard and see you can tackle those problems. If not, I'm going to email you. Okay, Blackboard might not have the right information, to be honest. You know, there's some people, someone else put that information together, and the school asked me to teach these classes at the last minute. So I got to look at what Blackboard, what they put in the Blackboard, and if you can answer those questions, good. All right. Okay then. Well, enjoy watching these videos. Again, as I said, if you have any questions regarding, if you need more clarifications, if you didn't understand the certain items that I discussed, if I go too fast, let me know. Okay.